All right, let's just jump right in. There's this incredibly powerful, almost invisible force that kind of shapes every single decision you make. It's this huge architecture of wealth and power that's always running in the background of our lives. Today, we're going to pull back that curtain.
I mean, seriously, think about it for a second. That mortgage rate you got approved for, or the rent you're paying every month, even the value of that home you've been dreaming of. None of that happens by accident. It's all being influenced by this massive interconnected system. And it goes all the way down to what's on your plate. From the global prices that determine how much a loaf of bread costs, to the supply chains that get that food to your local store. You can feel the effects of this system in every single aisle of the grocery store. It even dictates how you get around. The price of gas you see on the sign, the interest rate on your car loan, even the funding for the bus or train you might take. Yep, it's all part of the very same web. And here's the big one. It ultimately decides when you get to retire. Your 401k, your pension, your ability to just stop working one day, all of it hangs on the stability of a system we almost never get to see up close. So this system has all this incredible power over our lives. But here's the wild part. Almost nobody really understands who's actually in control of the money. It's probably the most important question, and for most of us, the answer is, well, it's a mystery. Now, you might be thinking, it's the banks, right? And yeah, that's what most of us assume. We see their logos everywhere, so it's easy to think the story just stops there. But that's just the tip of the iceberg. They're only the most visible part of a much, much deeper network. The truth is, it's a whole hidden network. Okay, so at the very center of it all, you've got the central banks, like the Fed here in the States. They're not dealing with you and me. They deal with governments and other banks, setting the core interest rates that ripple through everything. Then you have these absolute giants, pension funds. I'm talking about the groups managing their retirement savings for millions of people. That makes them one of the biggest, most powerful players in the stock market. Next up, the high-stakes gamblers, hedge funds. These guys are making massive, often risky bets that can literally move markets overnight. And finally, you have this whole ecosystem of other financial institutions, all of them trading, lending, and borrowing from each other, creating this vast, tangled web. And the sheer scale of all this activity, it's almost impossible to wrap your head around. We're not talking about a few million here, or even billions. This hidden network is quietly moving trillions of dollars around the planet, every single day. It is a constant river of cash that just dwarfs almost everything else. And that leads to a really profound point. Once you truly start to understand how this system works, you will never look at your own bank account the same way again. It stops being just some abstract concept. Suddenly, your personal finances start to feel like a small boat on a very, very big ocean. The real question is, are you ready to learn how to navigate it?
You get a paycheck, you pay your bills, and if you're lucky, you save a little. Simple, right? But have you ever stopped to think about what happens to that money after it leaves your hands? It doesn't just stop. It becomes a tiny, tiny cog in this massive, invisible, global machine. A machine that decides everything from the interest rate on your car loan to which giant companies will thrive and which will fail. Today, we're going to follow the money and see how that machine really works. Because it's not just about spending and saving. Not really. The moment your money hits the system, it enters this high-stakes game being played by some incredibly powerful institutions. It's a game with its own rules, its own star players, and, massive prizes. And here's the kicker. While most of us are just watching from the sidelines, it's our money that's actually on the field. So the big question is, who are these players and what are the rules of the game? All right, let's break down the players on this global chessboard. First up, we're going to meet the rule makers. These are the ones who basically design the game itself. Then we'll get to the everyday players, and that's where our money really comes into the picture. After that, things get interesting with the high rollers, the pros playing for billions. And finally, we'll meet the great connectors, the masterminds who link everybody and everything together. Every game needs a referee, right? Someone who sets the boundaries and enforces the rules. Well, in the world of money, that hugely important role belongs to the central banks. I want you to think of central banks as the climate controllers for the entire economy. Their main tool is something called monetary policy, and with it, they can either make it rain money to get things growing, or they can create a bit of a drought to cool an overheating economy. They do this by controlling two absolutely critical things: how much money actually exists, and more importantly, what it costs to borrow it. So how do they actually do it? Well, if the economy is slow, they fire up something called quantitative easing, or QE for short. They start buying up bonds, which basically floods the system with fresh cash and makes borrowing super cheap. But if the economy gets too hot and inflation takes off, they flip the switch to quantitative tightening, or QT. They do the opposite. They sell bonds to suck cash out of the system, making borrowing more expensive. This whole balancing act, this QE and QT, is what directly affects the interest rate on your mortgage, your credit card, and even what your savings account pays you. Okay, so the central banks are setting the economic weather. But who are the players actually out there on the field? Well, that brings us to the institutions we all deal with, the places where our own money actually lives, and more importantly, where it gets put to work. So your paycheck lands in a commercial bank. Now you might think they just, hold on to it for you, but their real job is to multiply it. It's kind of magical, actually. They take your deposit, they lend most of it out to someone else, and that loan becomes a brand new deposit in another account. This process is one of the most powerful and least understood forces in our economy. It's literally how new money is created, and it all starts with your deposit. And here's where it gets absolutely wild. In the past, banks had to keep a certain slice of your deposit on hand just in case. That was called the reserve. But today, in most major economies like the US, that reserve requirement is zero. Now, hold on. They can't just lend out infinitely. There are other regulations to stop that, but it just goes to show you the incredible, almost unbelievable power they have to expand the money supply. Speaking of incredible power, let's talk about the quiet giant in the financial world, pension funds. We're talking about $60 trillion. Just let that number sink in. That is more than the entire economies of the United States, China, and Japan combined. And almost all of it is our collective retirement money. So when you think about your 401k or your retirement plan, it is not just sitting in a vault somewhere. Oh no, it is out there, invested in everything from public stocks to iconic real estate. But here's the crucial part. Your retirement savings are the single biggest source of fuel for the high rollers we're about to meet. Your money is what funds the worlds of private equity and venture capital. Now, for most of us, investing really means mutual funds. And you've basically got two flavors. You've got actively managed funds, where some Wall Street pro is trying to be a genius and beat the market. And then you have passively managed funds that just copy an index like the S&P 500. And here is one of the dirtiest little secrets of Wall Street. The cheaper, boring, passive funds often give you better returns in the long run. Why? Because most of those expensive, active managers fail to beat the index anyway. Okay, now we're entering the VIP room of the financial world. This is where the money is bigger. The risks are way higher, and the potential rewards, well, they can be absolutely astronomical. First up, we've got hedge funds. In the US, you pretty much need a net worth over $1 million just to get your foot in the door. And there's a reason for that high bar. The regulators basically figure that if you've got that much cash, you can afford to lose it. Because, unlike the mutual funds we just talked about, hedge funds make these incredibly bold, super risky bets on everything from stocks going down to entire countries' currencies crashing. And to make those risky bets for you, they charge a famously high price. It's called 2 and 20. Get this, that's a 2% fee on all the money they manage every single year, plus they take a 20% cut of any profits they make. So if a fund is managing $1 billion, that's $20 million in fees right off the top before they've even made a single dime for their investors. Next up in the high roller room, private equity firms. The easiest way to think of them is like house flippers, but for entire companies. Their main strategy is the leveraged buyout, or LBO. They raise billions, buy a company using mostly borrowed money, and then, and this is the sneaky part, they load all that debt onto the company they just bought. Then they come in, aggressively restructure everything, and hope to sell it for a huge profit a few years down the line. And this model can go one of two ways. When it works, you get a success story like Hilton Hotels. The private equity firm Blackstone turned a $5.6 billion investment into a $14 billion profit. Wow. But when it fails, you get a tragedy like Toys R Us. It was loaded up with so much debt by its private equity owners that the company just couldn't survive. It collapsed under the weight of it all and filed for bankruptcy. Our final high roller is venture capital, or VCs. These folks are basically professional gamblers who invest in hundreds of risky little startups. They operate on a principle called the power law. And what that means is they fully expect most of their bets to completely fail and go to zero. It's like a baseball team that doesn't care about hitting singles or doubles. They are only swinging for grand slams, knowing they're going to strike out most of the time. And let's look at maybe the most famous grand slam of all time.
Back in 2004, an investor named Peter Thiel took a shot and put $500,000 into a tiny, unproven social network startup.
Well, that little social network was, of course, Facebook. And when it went public years later, that $500,000 bet turned into over $1 billion. That's a 2,000 times return. That right there is the power law in action. And that's the dream that fuels the entire venture capital industry. So, we've got the rule makers, we've got the everyday players, and we have the high rollers. But who connects them all? Who puts the deals together? That brings us to our final player, the ultimate deal makers of the financial world, the investment banks. Think of these guys as the corporate matchmakers of Wall Street. They're the ones who take companies public in those massive initial public offerings, or IPOs, like Facebook's $16 billion debut. They're the advisors on gigantic corporate mergers, and they help companies raise billions and billions of dollars in capital to fund their biggest, most ambitious projects. They're at the center of it all. So if there's one thing you take away from all this, it's this. These are not separate worlds. The central bank's decisions, your local bank's loans, your pension fund's investments, the high rollers' crazy bets, they are all just gears in one giant interconnected financial machine. And what's the fuel for that machine? It's every single dollar that we earn, that we save, and that we spend.
This machine doesn't just shuffle money around. It creates it, it multiplies it, and as we saw with Toys R Us, it can destroy value too. It is a global game that impacts every single one of us, whether we realize we're playing or not. So now that you know who the players are, how does it change the way you see your next paycheck?